First off, thanks for coming through and taking the time to watch my video. I really appreciate that. But I have to let you guys know that nothing I say is financial advice, and I'm not responsible for any wins or losses you take while trading, and I am by no means a licensed financial advisor. Now that we got that out of the way, let's go ahead and hop into this video. How do you mark a range? So when you look at this chart, this little example, the way I would look at it is, what 2 points did we move the most abruptly away from? What gave the big impulse moves? I would say that this is it right there. So let's just say you're up here in a range and you form that swing high and get a market structure shift. That's telling you that price wants to come back down. Now, the probability is raised if you've taken the external liquidity, like see how we came up and we made a high and then took it. So that was the external liquidity. It took that. Now you would look for it to come back down to a discount. Now, maybe there's a fair value gap right here that you would look for it to draw to. And then after it comes there, you would shift into your low time frames, start to look for those market structure shifts telling us we're going up and seeking out the buy side liquidity of the range. Now, the more liquidity you have still in a discount, the less probable that you're just going to rage all the way up to these highs. Something can happen like this, where you come up and let's say maybe there's a massive fair value gap right here and price does this, bam, then you've got lows here, and let's just say you have some kind of gap down here. Well, price might come down for all that and then move up. So the less internal liquidity you have in a range, the more likely that you are to seek out external liquidity from your entry. The more internal liquidity you have down below you, the less likely you are to go for the high.